Hey everybody, this is Jose Blasco. We are about to get started our session in just a few seconds. Let's use this time for a quick sound check. As always, a quick message on the chat box. I said it would do just a quick hello would make me understand that you hear me and that everybody is ready to get started. So please go ahead and do that. Thank you so much, Clive. And that way we can start on time. We got 15 seconds to go. I will turn on the video stream so I can position myself in the bottom right side of the corner. Oh, I'm just using, I believe, using the wrong one. 1 second. Here we go. How are you, everyone? From here, from a little corner, that's it. The countdown hit 0. So it's time to get started. I am highlighting the disclaimer for the session. Please read it carefully. This is important information. This is important stuff. Trading is indeed a game where there is real money involved and therefore real risk. So please read it carefully. Today is Aug-11, 2021. This is Options with Options. My name is Jose Blasco. We're going to be spending an hour in our private room, around 30 minutes or so in the public channels such as YouTube, Twitch, LinkedIn, Facebook, and so on, going over options trading. And the idea is to identify what's out there, adapt to the market conditions with various option strategies, and set up those setups in a way where risk is under control, and we apply the methodologies to our greatest benefit as possible, stacking odds in our favor. Agenda will look at the current market environment. From there, we'll review the trades that we have running at the moment. We'll talk about trade management, if anything needs to be done to those trades. And from there, we'll move into trade execution. So that is the plan. And therefore, let's get started. Okay. Nice. Okay. So just looking at the chat boxes. Yeah, all is good, all is under control. Very nice. Christian, how are you? Ahmed, Siderman, Mario, everyone. It's very good to see you, my friends. And exciting Wednesday and Thursday. Always very, very happy to be back on the Thursdays and on the Wednesdays and the Thursdays to spend some time with you guys. So anyway, so let's begin. So what do we have? Okay, so we start with the S&P. First thing that we can see with the S&P is that we have a confirmed climate. Climate is confirmed 6 out of 7. So we are in a healthy market condition where the market is moving higher. The market is supposed to continue moving higher for a little longer. That's what climate suggests. A little bit of a note of caution here when looking at the implied volatility between the calls and the puts, where we can see the puts since just a few days are kind of gaining against the calls. Okay, we used to have the blue line above the gray line. The gray line represents the puts, and now the put implied volatility is above the call implied volatility. Now the difference is extremely small, 1067 to 11. So it's not like this is going to change the world, but indeed we can see a little bit of different behavior among the traders, where there is a little bit of leaning against the put side. Okay, so if we look a bit deeper into what's happening with the options, so we can see 1.2 times more puts traded than calls. Here is 1.1 times more calls than puts, 1.2 times more calls, 1.5 times, 1.6 times. In other words, in all cases, the values are quite minimal. Nothing is too impressive. But we haven't seen for a while more puts than calls, okay, at least in one expression date. So this is likely the reason why we have a little bit extra implied volatility building up on the put side, even though, again, so far it's not like we can kind of anticipate a very strong turning point. At least based on the climate, we still supposed to have the market continue higher. We have a UFO very close by. Beyond that, if we look at the 2-day time frame, we have 2 UFOs stacked on top of each other all the way there on the top, making all-time high, right? So would not be surprising that prices retraces a little bit, but with 2 UFOs in there, we should see price bouncing back up at least a bit. Ideally or typically reaching that number 7 on the climate, and from there, then we may need to have a little bit of a pause. Statistics suggest 2 candles. So sometimes it's 1, sometimes it's 3, here is 4, here is 2, right? So a little bit of a pause before this incredible uptrend resumes, okay? So that's what we have with the S&P. If we look at the VIX, we can see options prices going down, 16.40 currently is the value for the VIX. Now, again, if the market drops a bit, it would be normal to see the VIX rallying a little bit. And notice that right on top of price, we have two UFOs there. And these are likely going to bring the VIX down, which again coincides with the market resuming going back higher. So that's what we see. That's what it looks like it's more likely to happen than not, which is the market to continue moving higher, even though we may have a little bit of a pause. I mean, today, tomorrow, we may see the market continue going higher. Maybe into Friday, Monday, something like that, we get a little bit of a pause, and probably next Wednesday, Thursday, when we are back, we are seeing now the climate getting back into the blue territory. Something like that is what would be expected. Again, this is important for us to have the right expectation. At the same time, we are not, and I discussed this before, we are not discussing about what is the current market environment, so we can create a bias for ourselves, and now the only thing we do is buy stocks just because, right? So that's not the case. The assumption is that in your portfolio, you're running trades that some of them are pointing to the upside, other trades are pointing to the downside. Some of those trades are hedging the other group of trades, and in parallel, we are entering non-directional opportunities such as iron condors, providing negative vega, or double calendars, providing positive vega, where all of these provides also positive theta. And therefore, the idea is to kind of balance out that portfolio. So again, the market analysis we are doing now to try to understand what the S&P is going to do, this is kind of like useful when it comes to understanding, should you hedge or not? Do you have too much exposure to one direction in the market given what's likely to happen? So, for example, if right now you were to be fully long and all your trades are long and you have nothing short in your portfolio, it is indeed time to start looking for some short, because if the market was to not only to fall for a couple of candles or three, if the market was to take a serious dip, at least one or two of those short trades would help offset some of the pain and create some profits, while then potentially the market comes back to normal and then your other trades profit, but in the meantime you collected some gains on the way down. So again, that's what I mean by hedging. Okay, so keep all of this in mind, and for the ones of you in the sessions regularly, you've heard me talk about this all the time. For the ones of you newer to the sessions, okay, so keep that in mind. Okay, how are you, Joanne? Good to see you. Very good to see you. Very good. Okay, so let's continue. Okay, so we know what we have out there when it comes to market conditions. So maybe now it's a good time to go ahead and take a look at a couple of trades that we have. One is SKT. This is a trade that utilizes August 20 expiration. So the last week, I believe, if I'm not mistaken, we saw that UFO. That UFO seemed to be quite strong because since then the price is moving higher. So we have the price currently trading at 17.57. But again, for this trade to profit, it needs to go all the way to 21 before August 20. So it's, unless amazing moves like moves of this sort happen multiple ways in a row, so it's looking like this trade will end up losing what was pre-planned, which was $57, if I'm not mistaken. Let's see if I have good memory. I am loading Option Station Pro now, and that's probably what's going to happen. Okay, so again, sometimes the market is surprising though, and you have these amazing moves, and next thing you know, you're back in business. So that is the beauty of working on those trades when they move against us, and we can have those various options tweaks, such as converting a horizontal spread into a debit spread, vertical one, which is what we did with SKT. Okay, so with SKT, getting into this, by the way, is TradeStation, in case you haven't noticed. So if we look at our simulations here for SKT, so 67 minus 10, it's $57 of raise. So the most you can lose if the stock stays where it is 57. But if it goes above 21, now you're gonna make like $40 something. Okay, so this is the risk profile of this trade after doing that tweak. Okay, the other trade that we have, actually not here. The other trade that we have here is First Solar. Okay, First Solar is a trade that we entered last week. The trade was entered on that particular day, okay, and since then it went higher. And currently, if you look at your PNL, if I look at it on Thinkorswim, it's showing $161.50 per contract if you are in this trade, and I believe that some of you are in it. So looking good so far. Now, the question is, looking good so far means nothing, right? So what are we going to do with this trade now, right? That's the real question. So let's go ahead and assess a bit deeper what's happening with First Solar. And first thing that we can see is that the climate is getting a little bit overextended. Okay, 8 out of 6. Okay, that's a little bit overextended. And since a few days ago, the puts are also gaining against the calls. The gray line is above the blue line. So from behind the scenes, okay, there is some building up of a bearish sentiment on the trade. That we don't really see yet on price movement. I mean, if you were to read candlesticks, again, the market hasn't closed yet, so it's not time to do it on the daily time frame yet, but this would be a little bit of a bearish candlestick, isn't it? So we can see a little bit of bearishness coming in, at least intraday. And if we look at the options, it's a bit neutral. It's a bit neutral, where we got 1.6 times more calls than puts, but again, this is the average of calls and this is the average of puts, and in none of the expirations we're not even getting close to any of the average volumes. So and here you got 6, okay, but it's because 6 calls were traded on only 1 put. So liquidity in that expiration date, September 3, is not the best, and therefore is not that significant. Okay, so yeah, this really, I mean, we love to look into the options markets to get an edge when it comes to market direction. Autoclimate is the key, really. We are using the options data to either get a warning sign or a confirmation. And in this case, unfortunately, from the options arena, we get a little tiny bit of a warning sign, but notice that the difference between the implied volatility of the calls and the puts is 37.33 to 37.67, which is extremely small difference. So again, we cannot say much, okay? So, what to do in a case like this, right? So, well, the normal action, it's just what we do in trading. In this case, is just to wait for that stock to do what it has to do. The climate is a bit exhausted, but again, there is a UFO below. This is similar to what we see on the S&P, where there are UFOs below. The climate is getting close to exhaustion. The puts are a little bit higher. So it's all very, very similar. But remember, the beauty with First Solar is that stock belongs to a group which is strong. When we did the research, and we found that stock belonged to a strong group, isn't it? And therefore we need to let the trade to develop and do its thing. And in this case, it seems that it's going to take time for us to have that nice push. Which, by the way, the S&P, I didn't say it, but the S&P is again teasing that all-time high situation. So if we do have a push, First Solar belonging to a strong group, that stock should push very, very heavily to the upside. Okay, so far it's been moving nicely, but we may have an even faster move. Okay, so we'll see. So there is not too much we can do really at this stage. Okay, and there is not too much we can do. We are in the trade. Everything is kind of like according to plan, and that's what it is. Okay. Also remember, when we looked at First Solar, while you see and this is the other reason why I'm not too concerned, you can see the climate 8 out of 6, and you may be thinking, oh my God, this may move against me. But if you recall, in the scanning, and I'm going to do it again today. So in the scanning, we were looking at setups where the weekly climate, okay, was in an early stage. So notice how the weekly climate is 2 out of 8. So again, I'm okay to get 3-4 days in a row of having First Solar to drop on a daily time frame, which is what statistics suggest when it comes to red climate. Because if that's the price to pay to get to see that stock, to fall for 2, 3, 4 days, get to that UFO, and then come back up, okay, see the stock go from 95 all the way to 93, but then come back up, well, it's actually, normal price movement, if you wish, and this in the context of a weekly up climate. So it's what you should be expecting. So we need to let that stock to breathe. We don't want to be over, kind of like micromanaging the trade too much. Even though we can see a little bit of put strength kicking in, and that of course is not good, but it's so minor that so far really there is no major concern. Okay, so option number one when it comes to First Solar is just do nothing. If I'm not mistaken, we set the target to be 102. I believe that was the target for the trade. I'm just speaking out of memory. I'm not sure. Did I? Let me see. Yeah, I think I was using another top when I did it. Yes, exactly. So 102 is our target. Okay, so we are shooting to get there, and we haven't got there yet. So we need to let the stock do its thing. So that's option number one. Now, on the other hand, there is always something that is good to do when it comes to trying to offset the risk and give the trade a better chance, and lower the risk of the trade while you add more trades in your portfolio. And I see that you have some notes there on the chat box. I'm coming to you in just a moment, guys. But so I was saying that the other thing that we can always do or try with options is to try to go ahead and do something about this trade to try to offset potential problems. Okay, now this trade is a bull call spread. So if I recall, well, I don't have it here. Okay, I don't have it here. So let me go ahead and add it. Okay, so this trade is a trade that we executed using First Solar October 15 expiration 92.5 115 call. Okay, so October 15 expiration. Let me do this. So it's a bull call spread using October 15 expiration, where we were buying the 92.5 and we were selling the 115. We're right here, and we were selling the 115. Okay, so this is the trade that we did. Okay, so I'm just gonna copy this trade. Well, actually, if I do it like that, I can do a bit more. I can save myself a bit of time. So the fill price that we got on this trade was 580 and 91 cents. So I'm gonna add on my simulation 580 and 91 cents. This is what I got on my end. And if I do that and I right click and I copy, so now I can get into my position panel and I can paste my position here, right? So now I can analyze it in real time. This position is making $160 of profit, which is what we see on Thinkorswim as well. So now I can go back to this and keep analyzing this, right? So what am I going to do with this trade? Well, what I'm going to do with this trade is, when it comes to trade management, so I can come in here and right click and right click on this trade and create a risk graph. So now I can analyze, what is it that I have in my hands. And again, this is where we're at the moment. Let me load here. So, currently this is where we're at. And this means that the trade is making, $160. Okay, so we know that. So now, the question is, at this current stage, the worst case scenario for the trade is to lose 489, which is the premium paid. Okay, and the best case for the trade, if we get to 102, will be to make 491. Okay, so this is the trade that we have on our hands. Okay, so we are shooting to make 400 something. We are risking 400 something as well. So this is the setup that we have so far, right? So what can we do in this case to make this a bit better? Well, again, since the stock hasn't moved too much in our favor, okay, since the stock has not too much in our favor, there is not too much I can do, but I'm gonna try. Okay, and I'm pretty positive it's gonna be a no-go, but I'm gonna try to convert this bull call spread. Okay, I'm gonna try to convert it into a directional call butterfly. Okay, so what is a directional call butterfly? So we'll talk about this properly when possible, but crash course on butterflies. So you have a call, then you have two calls, and you have a call. Okay, so that's a directional butterfly. So you have one call below, two calls in the middles, and one call above. And typically, if you construct it like in a traditional way, it's same distance from the calls you buy to the calls you sell. Okay, so same distance, same amount of strikes in between. Okay, so in this case, what do we have? Okay, well, we have the 92.5 call that we bought the other week. We have the 115 call that we sold. Okay, and this is already in the account, and this is now producing $160 of profit as we speak. So what can I do? Well, what I could do to convert that into a directional butterfly is to sell another 115 call. Okay, and then depending on what strikes are available, so look at the distance between 115 and 92.5, which, if I'm not mistaken, is going to be how much would that be? That would be 122. Sorry, that would be $22.5, right? So then I would add $22.5 above, okay, and this would allow me to buy a call, which is going to be like 130 something. But again, that looks a bit far from me. I'm not sure about the strikes available. So let's say it's 135. So if I was to buy 116, if I was to sell 116, 115, and I was to buy 135, together with what I currently have, if you think about it, this is going to bring some credit in. And therefore, it's going to lower the cost of my bull call spread and still get me bullish, still get me a positive delta opportunity while I am reducing the risk of the trade. So if the stock was to, again, what we saw on the puts, right? The puts are, the implied volatility of the puts is going up. The S&P may be getting a bit tired. So, if that stock was to fall, so by doing this tweak, we're going to suffer less. But again, this tweak may not be worth it, given the fact that the stock has moved nicely, but only 1 week, right? So if I'm not mistaken, we calculated the target date to be in September. That's why we're using October expiration. So, again, I'm not sure this is going to work well, but I want to try anyway. And before I try, I want to read the chat box. Yeah, the group is down 3% today. Get you, Christian. Mario, Jose, could you please show which is the maximum profit we can make on FSLR? Yeah, I just showed it a moment ago, even though I was not reading you. It was here, Mario. So if we go to 102, somewhere there, so the maximum profit is 490 something if you reach today, which is not going to be today, and it's going to be 469 if it's expiration date. Okay, so if you reach somewhere in between, so it's going to be 480, something like that. Okay, that would be the profit. We could certainly simulate the date we did when we took the trade, actually. So I'm not going to do it now. Okay. Yes, Siderman, if we reach to 102, then we are out of the trade. Stock is currently trading at 95, so there are still $7 to go to reach our target. Adding positive theta, Joe. Yes, correct. Now I'm reading your second message. Exactly, adding positive theta. So take a look. So if I go ahead and I take my current bull call spread with the fill prices of 580 and 91, and I add two more legs. Okay, which those two more legs, I'm going to get them at current price. So I'm going to pick the mid. Okay, and the next two legs are going to be, sell another 115 and buy one. What's the highest? The highest on the option chain is 140. Let me do the math. Let me make sure I do this right with no mistakes. So 115 minus 92.5, okay, plus 115. That is 137.5. Okay, well, that doesn't exist. We have 137.5 or 140. Okay, so I'm just gonna take the 140. And if we were to do that and I click OK, okay, so be ready, I'm using 115, 140, right? So currently our spread cost 489. This is the spread we have in the market now. So if I do that, I will bring in 115 minus 41. That's the new credit I will bring in, and therefore the cost of my spread is dropping to 415. And notice that if the stock goes up to 102, which is here, so I'm still making money. I'm going to make a bit less. Okay, I'm going to make a bit less. 415 is the amount of money I'm going to make if I reach today. Now, if I reach on the expiration closer to the expiration date, actually I make more, right? Because now I got two short units, so I am collecting more theta. Okay, but again, we are expecting to get there on September. So, to be honest, it's not a bad choice to do it, because if we do it and we reach our target on the expected date, we will be making, somewhere between 400 to 500, which is, very similar to what you would do without converting the trade. Now, I'm not inclined to do it because while from the profit point of view, it's very similar, from the risk point of view is also very similar. So instead of $489, I'm now risking $414. So the most I can lose is 414.5. So in other words, it's not like I got a massive benefit by doing this at this moment in time. It's not like the benefit is so crazy amazing that next thing you know, that's it. Now you are all happy about doing it now. We need for solar to move a bit higher, maybe go to 97, go to 98. And if it goes there, then doing this tweak, converting a bull call spread into a directional butterfly, would certainly help to manage the risk of the trade by diminishing the risk and maintaining the reward quite similar, right? And this is something that we welcome, isn't it? If the reward is going to be similar, but you reduce the risk, that's nice. Okay, it's just that in this case, it's very minor. So, only 1 week of time has passed, isn't it? So we're gonna have to let the trade play out and do its thing. So just be patient with First Solar if you're in the trade, and that's it. Okay, so that's the end of the First Solar conversation. Okay, any question over there, everybody? How is it going? Any question? Let me know. I'm just looking at the various chat boxes. You guys don't be shy. Participate. Let me know how things are going, so that way I can help you better. Good. So I'll be watching for the chat box. In the meantime, let me go ahead and bring the matrix. So we're gonna start looking for new trades, okay? Because this is now the time to start looking at new trades, okay? So what are we gonna do today? Well, today I would like to start working on non-directional opportunities, okay? I would like to first focus on non-directional opportunities, and from there I will be looking for directional opportunities, and since we have one long, I would like to be looking for one short. So let's see how much time we have available to do all of this, but at least I would like to start getting you introduced to how to do, thank you, Joanne. I would like to start doing non-directional trades, and I'm gonna start with iron condors, okay? So how am I gonna do that? Well, the first thing I'm gonna do is to look for options that are pricey, okay? So we want options with decent amount of premiums. So hefty premiums is something that we obviously welcome. So I'm gonna start with CAV mean greater than 80. Mari, if we're making 30% of the maximum profit, does it make sense to close the trade? I would say no. I would say you are betting on a sector, you are betting on a stock, you are betting on a climate, you are betting on many things. Weekly climate, and the trade started 1 week ago. I would feel it's too soon to give up on the trade. Plus the trade is working well. So far the plan is the plan is being met, right? So I would say there is no reason to do that, Mario. Okay, we definitely need to try to maximize the profitability of our trades. Okay, this is a very important concept in trading. So when you take the losses, then those losses hurt less. If you take profits too soon, then it's a problem. Okay, so what we'll do is, instead of being active on closing trades, if we see any threat, what we'll do is try to be active on offsetting problems by converting option strategies to other option strategies. For example, what I try to do, which is converting a bull call spread to a directional butterfly, even though it was not really worth it, so I didn't do it. And we are still relying with the underlying asset, Mr. First Solar, to keep going. But again, in many other cases, okay, like we've done before as well, and you've seen it, Mario. So we'll be taking an option strategy and keep tweaking to work on those rewards and those risks instead of just closing the trade. So we manage that while we still give the trade the opportunity to do its thing. Okay. Yes, damage control mode, but damage control mode really is when things go against you, right? Which in this case, things are just progressing according to plan. So all good, everybody relaxed. Let's go with the flow. Is that making sense? Cool. Good questions, very good questions. So CIV mean range greater than 80, this will guarantee my options are gonna be quite pricey. Okay, of course, this is a very I mean, the conditions I am selecting are again, quite restrictive. So remember, I'm going to start with very low short lists. Okay, most of the times I will be working with very short list, but I will have multiple ways to create multiple short lists. So every time it's kind of like short list of quality, and every time you have reasons to trade that list, instead of a very long list where some symbols are better than others. Okay, so I'll start with condition mean range greater than 80. I'm looking at stocks that are $34 or more, with some liquidity on the underlying asset. If there is no liquidity on the underlying, forget about the options. We're looking for stocks. On the stock filter side, I'm not filtering for anything because I am looking for non-directional trades. So stock filters or auto climate, it's unchecked. Okay, no filtering based on that. Scan list, I uploaded my scan list, the one with the how do you call it, penny increment options. Thank you very much. Okay, so this is the list I have loaded. Okay, and that's my scanner is filtering based on that. And then finally, I got two more boxes here to tick, which is earnings. I am excluding any company that is reporting earnings in less than 3 days. So that is the exclude. If those stocks report earnings in the next 3 days, they will be excluded from the list. And finally, this is the key. For my non-directional trades, I'm going to be looking at neutral strength in 2 different time frames. And the time frames I got to set are 4: daily, 2-day, 3-day, weekly. So what I'm going to do is to combine. So on one side, daily, check mark. On the other side, weekly, check mark. This is giving me one opportunity. So let's go take a look at that opportunity, and then I'll come back to here. So BHP, which, by the way, that stock is not the boss liquid in the world, but let's take a look and see if we can do a trade. Okay, look, the first thing that we can see here, if I look at that stock in a daily time frame, you can see those vertical lines which represents the expiration date, right? This is a tool that we call the probability cone, which not only gives you the cone, but also gives you the expiration date. So what's the problem with that? Well, the problem with that is that if we only have monthlies, okay, plus I see no signs of earnings reports on the bottom on the time axis. So that probably represents a stock that may not report earnings, and definitely with only monthly expirations, most of the times we cannot do too many things, like for example tweaking our trades and rolling and all of those things. So I'm just gonna pass, okay, and go back to my scanner and now work on the different expiration dates. So I'm gonna start from the left, okay, and combine the daily with the weekly. So now I'm gonna combine the 2-day with the weekly and scan and see if I got something different. Still the same. I'm gonna combine the 3-day with the weekly, and it seems that I get the same. I'm gonna combine the 3-day with the 2-day, and it seems that I get the same. And I'm going to combine the 3-day with the daily, and it seems I got the same. Okay, so in other words, options that are above the 80 percentile are not so many. Okay, so I'm gonna have to look for another criteria for pricey options, but are not that extremely priced, okay, because that sometimes is too restrictive. So I'm going to be looking at CIV mean minus historic volatility to be above 2 standard deviation. And when I do that, now I am getting more symbols. Okay, so I'm going to go back to my original setup with daily and weekly. I mean, nothing wrong with starting differently, but I just like to do it like that. So daily on the left, weekly on the right, and now we can see we got 2 stocks where the implied volatility is 2 standard deviations above the historic volatility, and that would be Sienna Corporation as well as CRM. Okay, earnings on September 2nd, August 25. So let's take a look at that on the chart. Okay, so we'll start with Sienna Corporation. So let's take a look. Okay, so here is a Sienna Corporation. We can see our probability cone. Okay, we can see the vertical lines that represents the expiration date, and we can see the next earning happening here on September 2nd. So in other words, if we do a trade with that stock, we should be relying on August 27. Okay, August 27, it's the expiration date, the furthest out expiration date that we are allowed to use. If you use the next expiration date, you may have earnings explode against you because they are being reported prior to the expiration date. So you don't want that. You want to use the expiration date, which is prior to that, or the one prior to that, or the one prior to that, but not after that. Okay. So then in our mind, we need to keep now August 27. Okay. But what else? Well, the first thing that we're gonna do is that we're gonna project. Okay, we are going to project the various possibilities for price range. Now, sometimes, and this varies through time, sometimes in the probability cone you will see the red line beyond the blue lines, and sometimes you will see the red line within the blue lines. Okay. So what is the red line? What are the blue lines? Okay, this is probably what you're thinking. Ahmed, when we will get this software? This is such a good question. We are working so hard. I was really hoping to have it ready for production 2 weeks ago. And I guess that, final stages, I mean, we know that, right? Final stages of launching a software always have a few last minute surprises, if you wish. So we have a little bit of delay, okay? But it's not going to be too long, guys. I may repeat myself if I say 1 week or two, but probably it's more 1 week than two. So it's really, almost ready. So maybe tomorrow I can give you more news. And if not, definitely next week I should know the exact date, because we are so close now, guys. So yeah. So anyway, so what are the blue lines and what are the red lines? Okay, so look, if I right click and then I edit the probability cone, so here's our setup menu, and notice that what I'm doing, sorry guys, I need to take a sip of water if you don't mind. Sorry for that. So the one thing that you can see here is, number one, that the baby blue color line represents the 21-day historical volatility. So in other words, this is the speed of movement that the stock showed during the last 1 month. The chart blue color, it's 42 days, which is 2 months. So it's the speed of movement of the stock in the last 2 months. And the navy blue color is 63 days, which is 3 months, and it's also historical. So the 3 blue lines are showing the speed of stock movement in the real world during the last months, the last 2 months, and the last 3 months. And then with red color, we are not looking at historic volatility, we are looking at the implied volatility mean. And the implied volatility mean in this case represents what, based on the options prices, what people expect the move to be into the future. Okay, if many people are buying those options, is because they expect a move. So the volatility, which is implied, how eager are people, to buy those options, and therefore based on supply and demand, what are the current prices of those options? So that volatility built in the prices of the options are revealing, okay, that expected price movement. So what we're doing is that 68.27% is a 1 standard deviation. So what we're doing is that we are projecting, where the stock should be in those future dates, if the stock was to behave based on either historic volatility or implied volatilities, on a 1 standard deviation of the cases. And therefore now you can see your worst case, if I go to August 27, so you can see your worst case is here. Okay, so this is your worst case, okay, and this is your worst case. Okay, so from purple line to purple line, that would be, we'd expect the stock to stay between 58 to 54. That would be the expectation of movement for that stock. So now the question is, do we have UFOs, right? So I'm going to drop to the 55-minute time frame and look at UFOs, and indeed we have UFOs above and below. Okay, but what's the bad news though? Well, look at the probability. Okay, it's not very encouraging. The probability for those UFOs is not meeting our rule, which is 48%. So what are we gonna do? Well, we're gonna add a few more rules to certain things that we've been doing to give ourselves a bit more flexibility within the context of adding probabilities and making sense as a process. So what we're gonna do is we're not gonna go down into lower time frames, but we're gonna go up using fib numbers. So the next fib number after 55 is 89. So if I look at 89, probability is 47%. So it's not 48. So if I look at 144, which is the next fib number, probability is 45%, no good. If I look at the next one, 233, so probabilities, and data is being downloaded, and my internet is a bit slow today. So 52%. So this now meets our rules. Okay, with that time frame, we are indeed meeting our rules, and we have UFOs there. Okay, again, our condition is at least 2 UFOs, right? So on the upper side, indeed, we could rely on that upper part of the UFO. Okay, and that would be the top part. On the bottom part, that UFO is not good enough because it's only one UFO. We need 2. Okay, so I could keep going to the next time frame, which is 377. Okay, 377 is giving us 35%, so that will not be acceptable. Okay, and beyond that is daily time frame already, right? So what is the daily time frame? Well, the daily time frame is providing 55.56%, so that's acceptable. So now the question is, if I look at this UFO, the bottom part of it, it's only one. But if I go back to, I believe it was the 144 minute time frame? Or no, it was the 233. Let me see. Yeah, 52%. So yeah, so look, this is the UFO that we find on the daily time frame. The one that we find on the 233 minute time frame is here. So in other words, not a problem setting an iron condor, expecting the price of the stock to remain trading between 61 all the way to 51 point something, and the price is currently more or less in the middle. So this is, from a setup point of view, looking good. Okay, so now the question is, are we going to meet all those conditions in the option chain? Okay, and you guys remember that if I was to do this with TradesTation, I would come to an option chain and I would need to look at the strikes one at a time. So I'm not going to do this. I'm just going to use the spread builder, spread select, and with spread select, what I'm going to do is first select the right type of spread. So I want to build an iron condor. Okay, so short iron condor. We said we're going to use expiration date, which is 27th of August and 20. Okay, we are not going to use, 2 days of expiration is going to be a waste of time. But we're not going to use September 3 because earnings are there, isn't it? So we're going to do August 27 and August 20. And then the minimum range is, we're going to select $1. Okay, I'm not going to select 50 cents, which is the minimum possible. Okay, this list will automatically show you what's possible based on the option chain. So based on the option chain, what's possible is to do 50 cents. But I'm just not going to do it, because if we do 50 cents, then to have a proper trade, you're going to have to use so many contracts, right? And then you're going to get killed on commissions. So we're going to start with $1 minimum, and we're going to make, for the price of the stock, which is a $50 stock, we're going to go $5 maximum. Okay, so 1 to 5, this is the distance between strikes. Okay, distance between strikes. So when you do a condor, you are buying a call, selling a call, and then selling a put, buying a put. That's a condor, right? So we are talking about the distance from here to here and the distance from here to here. How much is that? So maximum 5. And why is that important? Because, as you know, that sets your risk, right? So if the distance between strikes is 5, the most you will risk on the trade is $500 minus the credit collected. Okay, so therefore we're gonna go ahead and do that. Set minimum is 1, maximum is 5. We're gonna create 99 iron condors, which have just been created in front of us, with all combination of strikes as possible. And what we're gonna do now is to just load the adequate template. So let me load it, and then I'm going to show you what the content of the template is. I have a template here ready. I will share that when the time is right, guys. Iron condor preferred parameters. I'm going to load the template. And as we are loading the template, so notice how this template is asking for the long legs to be outside the ideal zone. We are also looking for the short legs to also be outside the ideal zone. We are looking for all options that we sell all legs must pass. For all options that we sell, that we collect at least 35 cents. Okay. We are also looking for the probability of those options to expire in the money or to break even at least is 30% and 25%. I'll talk more about that in other sessions, but basically what I'm doing with that is making sure the options that we sell are far. Okay, I'm doing that thanks to outside and thanks to those probabilities. Okay, why do we want them far? Because they need to be above 61 or below 51, right? So they need to be far. And then I'm looking for the return on investment to be at least 25% of the P&L on the expiration. The rule that we have is 15%. We'll take 15%, but I want to start with, a bit more demanding because I don't need to do this manually. It's done automatically for me. So, it's okay for me to start more demanding. And if I find trades that pass a more demanding criteria, then it's better for me, right? And if not, then, I can always change that value to 15%. I may end up rising it, you'll see in some cases. And then also I want to be relatively well centered in the range, and for me to guarantee I am relatively well centered in the range, instead of doing measurements on the chart, I'm just gonna ask for my Greeks, my delta Greeks, to be between minus 0.1 to plus 0.1. That will kind of guarantee that I am more or less centered in the range. It doesn't need to be perfectly centered. It doesn't need to be delta exactly 0, but you don't want it to be too positive or too negative. That basically makes sure that you're going to be close to the midpoint. So if I do that and I click OK, and this is a stock which is low price, so we may get a pass or not. Yes, so it seems that one of those trades passes. Now, it doesn't mean we're going to take it. We still need to, confirm that's going to be valid or not. Let me re-update just in case. Yes, so we have one trade passes. Okay, so on expiration this trade will make $36. The trade is made of using 53, 54, 58, 59, meaning that we got $1 strike price increment, so there is a risk of $1 minus $36 of credit. So 1 minus 36 means that the risk of the trade is 64. So we're risking 64 in order to make 56, which is 64 in order to make 36, which is a 56.25% return on investment on expiration. And all those parameters are met, so the delta is relatively close to 0. The strike selected are far, all of that, right? So it's all good. Now, are we going to accept the trade, yes or no? Well, the ultimate condition will be to look at the break-even points. Okay, the break-even points of this trade. In other words, for you to profit on this trade, the stock needs to be between 58 and 53. And that doesn't sound good enough, isn't it? Yeah, Christian, that's going to save so much time, isn't it? Not only that, it's going to help us to find unique opportunities at times. Okay, I'll talk more about that. But anyway, so 58 to 53 doesn't sound to be good enough because we said we need to be 61, okay, to 51. In this case, it's more like 63 something to 58 something. So yeah, I mean, you would be above this and below this. This is a statistical range. So from a statistical point of view, this trade actually could profit. I mean, it could profit because what we selected in the filter actually suggests so, right? But if you only go with the filter without respecting the UFOs, now you may get a problem, right? So again, the UFOs are going to be key. The UFOs have been key in making our Aaron condors work well, isn't it? So we don't want to ignore that. And in this case, unfortunately, the fact that Sienna is low price point, the fact that the earnings are relatively close, and the fact that we didn't have more UFOs, and in the 55-minute time frame, the probability was lower. So in this case, created a setup where 61 to 51 is just a bit too wide for those options to justify the trade. Okay, and therefore, we're going to have to say no to Sienna, but we are now ready to repeat with CRM and see if CRM is going to be a yes or no. I'm going to restart the whole process, same process, guys, but please type on the chat box if that's okay, if you are following me or if you're not, right? And that way, when I explain all of this and I re-prepare the trade, I would know what to emphasize or what to discuss more precisely. Okay, so with CRM, earnings are happening sooner. Okay, so we cannot use the expiration date August 27. We need to be using the expiration date August 20. Okay, that would be the expiration date. Okay, so let's keep that in mind. We're gonna go with August 20 when we do the simulation. Statistics suggest I was using the wrong tool for the drawing. Sorry for that. Statistics suggest that from now until August 20, the price of that stock may be from here, maybe trading between here and here, okay, which is like 233 to 246, something like that. Okay, so now the question is, do we have UFOs to rely on to make this trade a high probability trade? Well, the good news is that on the 55-minute time frame, the UFOs are showing 52%. Okay, and there is a UFO right there, so that's good. The next UFO we can find on the 55-minute time frame is right there. That would be the next one, but remember we need two, minimum two. On the upper side, do we have UFOs? It doesn't seem that we have UFOs. Let me take a look again at let me check a weekly time frame for a second. Yeah, so there is price information much higher. So okay, so let me do this. Let me load more candles, still on the 55-minute time frame. Let me load more candles to uncover, because I got 500 candles by default. So what I'm going to do is format, and I'm just going to add, let's say 5,000 candles. So load 5,000 instead of 500. So we just need to wait a little bit for the data to come in. Here we go. I have it. And now we have more UFOs. Okay, probability is still very good, but you know the nearest UFO is so far away. So I'm not sure if I rely on this one, if the trade is gonna work well or not. Okay, in any case, I'm just gonna draw a line there so I know that is UFO number 1, UFO number 2. So I got 2 red UFOs. If I want to do something relatively equal distance, I will need to do something like that. So let me move it down. Come with me, something like that. Yeah, so we would probably need to rely on, you know, on those UFOs so much lower. Okay, so right now the range is not looking like very well centered at all. Okay, but it's okay. We're gonna keep adjusting this. So I'm gonna move to the 89-minute time frame. I'm gonna go up time frames as long as I got 48% or more. I'm gonna be okay. Oh, and yeah, and I guess I don't need 5,000 candles now, but it's okay. So what do we have? Well, actually now we have so many more choices. Okay, because in the 89-minute time frame we have 49.73%, which meets our rules. We have another UFO here, which would also count as UFO number 2, because we have UFO number 1 on the 55-minute time frame that was somewhere here, and this would be UFO number 2. So if I calculate the distance from the current price to here, okay, and I project this below, so that's perfect. Look at that. So this basically it's ending up here with that UFO located at around 215. So that would be a pretty wide range, but it would be well centered. I got multiple green UFOs below. I also got 2 UFOs above, okay? Because even though we only see 1 UFO, 1 red UFO, again on the 55-minute time frame, there was another one here, okay? So that would be a valid range, and therefore I do have a valid range now. It's very wide, okay, to 65. I'm not sure I'm gonna get paid enough because in this case I can only use 1 expiration date. But let's go ahead and try. Okay, so we're gonna go ahead and use the spread select. We are moving this to CRM. Expiration dates that we're gonna use is gonna be only August 20. Let me uncheck filters first. We're gonna start with 1. We're gonna start with 0. The minimum range is 2.5. So based on the option chain for that expiration date, strike price increments are 2.5. In this case, I would, because it's a $200+ stock, so even though I would prefer $5, I'm gonna start with 10. okay, and then I can always fine tune to have a trade that meets my criteria with less risk. I can also look at that. And with that in place, now I'm gonna ask Mr. Top to give me 99 spreads. Okay, so here are my 99 spreads ready for me. And now I'm just gonna filter them. Okay, so I'm gonna filter them. What are my parameters? Yes, I didn't change anything, so all is good. So let me update and let me sort. And now we got all those trades that pass. Okay, so now all those trades pass. Okay, but the upper part, the higher it goes is 253. That's the highest. 253 is the highest break-even point, where we need that break-even point to be 265. So this one is a shame, guys. Okay, if this trade, if we did this trade like another week before, I'm telling you this trade would have worked very well. But this week, given the fact that we only have 1 week to play with, so then we are not getting enough premium. We're getting premium all the way to justify a trade with 253 or something, which is there. It's almost a 2 standard deviation range. So, again, based on probabilities, it may work well. But again, we need to rely on those UFOs to be safer. So we are going to have to pass on CRM and therefore go back to our screener. Okay. So now I got these two guys. Okay. And now I'm gonna try and see what happens if I do 2 days. Oh, we got one new BBBY earnings on August 24. So it's going to be a similar situation. Okay, so let's take a look at BBBY. By the way, I don't need 5,000 candles. It's just downloading, guys. Okay, so just let's wait for a moment. Okay, so let's go ahead and look at a daily time frame for BBBY and see where we're at. So again, earnings right there, so we can use all the way to here. We are going to set the range to be from here to here and from here to here. That will be the range using, again, August 20 expiration. You can see on the bottom part of my screen. So moving down to the 55-minute time frame, we got 42%. That's not acceptable. What if I move to the 89-minute time frame? 55%, that is indeed acceptable. So we got UFOs there. Okay, we got one UFO up there. We got UFOs below. 130, that seems to be quite far from me. Let me take a look at 144. %, that is good. But the UFOs on the other side are very, very far away. Oh yeah, because there is an open gap here. So the UFOs are going to be very likely pretty far away in most time frames. So I'm going to try 233. We're just being a bit unlucky here. I just had a trade that met all the rules earlier in the day with the CVX. Yeah, again, the red UFOs is the problem because of that open gap. Okay, so let me try to find something because we are about to hit the end of the session, and hopefully we can find one. Okay, so let me continue with my test. Okay, again, the fact that earnings date is on 24 is too close. That's the issue. So now if we do 3-day weekly, we got Sienna, GameStop Corporation, CRM. So GameStop, that one is new, but yeah, I'm gonna pass on this one if you don't mind. And now I'm gonna go for 3-day, 2-day. We got NTAP. Okay, so let's take a look at NTAP. August 25 expiration. So yeah, it's looking like, unfortunately, we may have a similar problem because we cannot surpass August 20. Okay, so let's take a look. August 20, wait a minute, that stock will be making all times high there, right? Yeah, so we cannot do NTAP. So one more choice here before I change to the other setting, Sienna and CRM, we saw that already. Okay, so now you guys saw me play with all those time frames, daily and weekly, to find those ranging trades. You also saw me change the implied volatility from the 80 percentile to above to standard deviations. Okay, the last one I'm gonna check. Okay, it's going to be a top increase in implied volatility in the last 5 days. That will also provide me with options that are very pricey, and normally I would have many more. Okay, so this is the one that normally provides the greatest amount of opportunities. Okay, but it's the one I like to start the least. Okay, because it's gonna be the less fine way on how to filter for high volatility, even though it is fine. So if I look at GLW, for example, we should be able to see how implied volatility, is not that low. So again, we are doing our own condor. We don't need it to be all the way to the top of the range. Okay, of course we try to get it all the way to the top of the range. That's better, but we don't need that. Okay, we don't need to be that high. So this is good enough, and you will see that, with that selection, that top percent increase in the last 5 days, we often have, volatility be far enough away from the bottom part. Okay, and you may be like, oh, it looks pretty close to the bottom. No, it's not, because the bottom is 37%, 41%. It's 4% higher, and that in implied volatility measurements is not a small amount. Okay, so keep that in mind. Okay, so we are doing our own condor. We don't need to be that precise on implied volatility. Okay, that one 22 again. So the bottom part is 20, so the top part is like 30. So again, it's not too bad. Okay, it's good enough to do a condor. We had many successful trades that we found with TradeStation using the method on the TradeStation scanner, which is less picky than what I'm doing now, and it's fine. So just be careful, because again, maybe you read a book, maybe you heard somewhere, that to sell options, prices need to be the highest as possible, and that's true, especially if you sell them naked. But if you are selling a double spread, which an iron condor is a double spread, so the long strikes offset the vega, so it's not that critical. Okay, the higher the better to get the most premium as possible, but it's not too critical. So that way on how to filter is indeed valid. Okay, so let's take a look at let's start with earning date, August, September, and all of this is October. So yeah, all of those are gonna give us plenty of dates. So let's use GLW, for example. So with GLW, okay, on the daily time frame, so again, we can see how earnings are happening all the way in October. The last earnings already happened. So here you can use any date you want. Okay, so normally, you want to go out, to have possibilities for you to do tweaks, right? If you do a 1 week iron condor, which is fine, there is no option for you to do nothing. Okay, take care, Clive. Okay, there is let me see, Siderman, I thought you use 1597 candles on the 55-minute time frame. Yeah, I was using those settings on TradeStation. Okay, but on top I set up the workspaces differently, and to be honest, the results are very similar. Okay, I mean, if you had 100 candles, then no, it's not representative, but even 300 candles is good enough to get some decent stats. With TradeStation, I was just taking it to the maximum, without getting to the place where TradeStation freezes, which is under 2,000 if you wish. But anyway, so I was saying that if you do a 1 week Iron Condor, August 20, there is nothing you can do. You do the Condor, you're right or you're wrong, that's it. But if you do a 2 week, 3 week, 4 week Iron Condor, then there are multiple things that you can do. Okay, you can work on the trade, you can do rolls, you can do different things. So typically we also get better liquidity when we are dealing with options which are monthly expiration dates, which in this case is September 17, and therefore I'm going to be focusing on those. Okay, so let's take a look at this one. I know we are running a bit late, but let me see if I can complete this. Okay, from here to here. Okay, so that would be our range going from 42 to 38 something. So that would be the range. So now let's look at the 55-minute time frame. It's giving us 43%, not good enough. We're gonna move to the 89-minute time frame. The 89-minute time frame is giving us 53%. That is good enough. Okay, so we have two UFOs there. Okay, so this UFO here would be good to set the top part of the range. Okay, so that would be good enough. Do we have anything else below? I'm guessing that maybe I need to load more data. Yeah, to get things below, I'm going to have to load more data. So let's go back to the 89-minute time frame. I'm going to right click and format. Okay, just need to be patient for the data to be downloaded. Here we go. So I'm going to load, 5,000 candles. Okay, with top, even if you load a huge amount of candles, it will not slow down compared to TradeStation. But of course, downloading the data takes time. Okay, so it's always good to minimize the amount of candles to be efficient when switching symbol. But if you are running multiple computer screens and things like that, and you have many candles everywhere, you are fine. That's not a problem. So the waiting that we have now is basically download time, which my internet was a bit slow today. So that's why, okay? So anyway, so here we go. So now we have UFOs below. So with the 89-minute time frame, my UFOs are located here and here. Okay, so this would be the location for, the second line, of course, because we need at least two UFOs. And from a centered point of view, so I think that this may do. Okay, so from here to here. So if I use that one above, so that would be a valid range. Okay, that would make me very nicely centered if I trade a range between like 45 something to 36, something like that. So that's a fantastic range. I mean, the question, of course, is always, and I picked a stock which is $40, so that's going to be difficult to get premium enough, I guess. But we're going to try. And if it doesn't work, then it doesn't work, and we'll continue tomorrow, okay? So now, in this case, we're going to use any expiration date all the way to September 17. So I'm going to check mark them all so we can analyze, because sometimes you get a surprise. You got extra volatility in some strike, in some expiration date. So we want to simulate all of that because the platform will do it for us. So it's not like we need to do it manually. Minimum is 0.5, so we're going to start with 1. And maximum, the stock is $40, so I would say that more than 5 makes no sense. And with that in place, we're going to do 99. And with that in place, we're now going to filter out. All the parameters are fine. So I'm just going to, yes. And we got one that passes. And the one that passes is using September 17 expiration date and is creating a range that goes from 43 to 37. And that's not good enough, correct? So 43 is here, 37 is there. So it's good, but it's not that good, okay? Now, is that a problem? Well, I'm not giving up yet, okay? Why? Because if you recall, we said earnings for that stock are happening all the way there. So actually, I could go to the next expiration date and even the next one, okay? Which is October 15. That would be like a long-term iron condor. There's nothing wrong with that. So, I mean, it's less advantageous from a time decay point of view, but there is nothing wrong with that. So what I'm going to do is I'm going to uncheck those expiration dates, and I'm going to check September 24 and October 15 and update and resort my filter. And now I got many that pass. Okay, so now I got the top is 43, 43, 43, 45, 45. So how much we said has to be 45. So we are meeting that. Okay, so we got 45. So 45 and then 36. 45 and 36. So we just found one here. So this trade would work. So 45 something and 35 something, that's good. And also 45 and 36, that's good. So those two trades will work. This trade provides 25%. This trade provides 36%. So this one is using October 15. where that one is also using October 15. So what's the difference? This is using 36, 35, 45, 46. This one is using 37, 36, 45, 46. Okay. So yeah, so the one above is it's a bit less aggressive but pays a bit less. The one below is a bit more aggressive but pays a bit more. But while it's a bit more aggressive, it's meeting our rules, right? So the bottom part was let me. Oh, actually, 36 something is higher, right? Yeah. So yeah. So then the one we should focus on is that one. Okay. So my friends, this is the one. Okay. So this is the trade that we're gonna take. Okay. I'm just gonna go ahead and put it in the platform. So this is the trade that we're gonna take. It's an iron condor made of selling the 36 put, buying the 35, selling the 45 call, buying the 46, all of these using October 15. So this is a long-term iron condor. It's like 60 days or so. Is it 60 days? Did I say that right? 65 days, correct. I said it right. So that's the trade. Multiple opportunities to work on this trade in multiple ways as time passes. So we'll be doing that, okay, and ideally improving the trade in many ways. So so let me place this order on TOS, and we will call it a day. I've been a bit stubborn today, but I was like, I'm not going anywhere until I got a trade, okay, and we did. So GLW, okay, October 15, we're gonna enter an iron condor made of 35, 36. Okay, 35, 36. I'm going to leave this on the screen, okay, so you guys can take a fair note, 35, 36, and then 45, 46. $45, $46. So let me review. I'm doing this right. So 45, 46, 36, 35. Yes, correct. Correct. So yeah, if I simulate this to get a feel for the midpoint on the spread. So the real-time midpoint of the spread, it's around 21 cents. Okay, that's the midpoint. We are between 11 to 29, so 21 cents should be achievable, providing that 35% performance. And here it says 20, 22 now, so I'm just gonna go with 22 and see what happens. Okay, so I'm just gonna place the order, and then I'm gonna show it to you on the screen. I'm gonna freeze the screen and zoom in while I wait to get filled, so you can take a screenshot or make a note. So this is the trade that we're doing, and that's it. Okay, so now again, you can see now how the process is so much faster that you know, the steps that we used to take. But not only the process is faster, so now we are able to explore other combinations of spreads that we were not able to do before, just because you know, it would take too much time to look at so many expiration dates and strikes and everything. But now we can just do it, okay? And then sometimes we have very happy surprises, and you know, I'll explain what I mean by that in another session. But basically, sometimes you have some strike which has lots of implied volatility built in, or the opposite, because maybe someone dumped, you know, 1,000 calls to be bought on that strike, and you know, the implied volatility went higher, and now you sell that strike, and you get a better break-even point, even with a different strike price that you would not expect. So all of these will be picked up by the select spread filters, and it will help us to find, you know, very nice trades. Okay, so anyway, so we have it here. I'm just gonna push this trade. Please don't do that, to be a market order, so I get it filled, so that way I have it. Okay, so I got filled at 21 in the simulation window. So 21, let me report that on top. So that means that I got for the 45 call 38. sorry, is it call or put? I said 45 call, yes. So 45 call, I got 38. Okay, so fill price 38 for the 46.27. So 27 for the 36 put 43 and 33. So 43 and 33. Okay, so now, so this trade now theoretically is making $1. Okay, and now we're going to be able to monitor this trade and work with it and go to the graphs, and we're going to be able to project it through time, and talk about this trade through time and what happens and all of those things. Okay, so we'll be working on all of this in future sessions when we do trade management. But that's it. The trade is there, is valid, and I would say the session is over. Everything good, guys? I'll leave here with that screen, so you guys may want to take a screenshot if needed. All is good. Before we go, I want to make sure everybody is with me. Yeah, got it. I'm just reading other chat boxes. Yes, perfect. Good. Thanks for those confirmations. Thank you, Joanne. We will take that. Yeah. Very good. So you guys take care. I will see you tomorrow, same place and same time. Bye, everyone. Take care. Thank you, Mario.